Over the last year, we've added LVMH, that's Louis Vuitton, Moët Hennessy, and really, to talk through our process, the number one criteria here is that this is a business with an incredible economic moat. It's a business that has about 75 luxury brands in its portfolio, but the one that really matters and the centre of that business is Louis Vuitton itself. And that is a business that has incredible longevity. It has brand equity dating back to the 1800s. And it is a business that's a brand that's lasted the test of time. Importantly, it has been desirable over the test of time. And supporting that brand equity really are several pillars. Obviously, there's a marketing pillar in terms of their ability to spend behind the brand and continue its popularity. There's the control of distribution, so that means you can only buy these products through their own stores. Why is that important? It means you control the service levels, you can control the ambience, you can control the price points at which these products are sold. So you'll never get these products at a discount. That's very important for brand equity. If we think back to 2008 and many brands that sold through, Saks and Bloomingdale's and many retailers like that were dealing with, those retailers discounting your products by 70 to 80%. It's incredibly difficult to retain brand equity in that scenario. These guys controlling their own distribution is incredibly important. The next pillar is supply chain. They internally produce everything. In fact, they've even bought up, crocodile skin manufacturers and farms around the world. These guys have that authenticity around that made in France, artisans producing your bag. That supports ultimately the brand equity of this business and the reason that they can charge the prices they do. And of course, being a scale player, scale is becoming incredibly important in retailing, where you have the ability through your revenue base to invest more than everybody else in your brand. And if you think about, the democratization that social media brings to apparel retailing, people say, well, you can advertise any brand you like on social media. But if you think about the capital that these guys deploy behind sponsoring all the right influencers and organising a tour to an exotic location around the world and flying everybody there, that is an incredibly expensive and difficult thing to do. And you need scale in order to do that. And that flywheel gets created of high revenue growth, higher ability to reinvest in your brands, and then a higher degree of brand equity over time. So that is really a pillar of the quality of this business. It's also incredibly well managed. If we think of their stewardship of businesses like Sephora or Bulgari, those businesses have done incredibly well under LVMH management in terms of profitability improvement. They're now doing it with Dior Couture, that's just been acquired as well. And of course, the next piece is valuation. This is a business that has an incredible structural growth tailwind sitting behind it. The approximately 10 million, high net worth Chinese individuals, that's growing at 20% per annum. These guys are tapping in to that opportunity. If you look at the last 10 years, about 70% of all growth in luxury has come from that Chinese consumer. And LVMH, about a third of their sales are coming from that consumer today. So you have a business that has a genuine structural growth tailwind sitting behind it. And when you put all that together, you have a very high quality business growing at a very robust pace, that's trading at a reasonable price. Yeah, I think the really interesting thing about Tiffany is what can LVMH do with the Tiffany brand? It was one of those businesses, that certainly has an incredible brand sitting behind it. Breakfast at Tiffany's, Diamonds Are a Girl's Best Friend, all of those things were there in support of the Tiffany business, but it wasn't a particularly well-managed business. It wasn't a business that had tapped into the Chinese growth opportunity. It wasn't a business that spent enough on marketing their brand. And they had a new CEO who was formerly from Bulgari, incidentally, who was trying to put all of these things into place. But of course, a turnaround is incredibly difficult to execute when you're a publicly listed company reporting every quarter. And I think the nice thing for LV is that they will be buying the Tiffany brand, which is incredible value, you know, again, it's lasted the test of time, you know, the blue box, you know, a patented colour that these guys have control of, but they can fix this brand under their umbrella. You know, they don't have to report quarterly, and they've been very clear that that was, you know, part of the rationale when it came together in terms of justifying the price. I expect them to invest more in the marketing of the Tiffany brand, and that'll probably take margins down really in the short term, but ultimately they'll set that business up for future growth and really to participate in that structural upside that exists through the growing wealth base in emerging markets, particularly China. So I think that'll prove to be, you know, given LVMH's track record in executing on their acquisitions, I think it'll be, you know, a very positive deal.